Stop everything you're doing right now, put your phone down, close every other tab, turn off the TV. Because what I'm about to reveal to you, what is happening right now in January 2026 behind closed doors at the world's largest financial institutions, will fundamentally change how you see the silver market forever. My name is William Lee. I'm 33 years old. And today, I'm cussing enough, I'm going to tell you the truth that nobody else is willing to say out loud. The truth your broker is deliberately hiding from you. The truth the mainstream financial media has been instructed not to report. And the truth about what BlackRock is doing with silver right now, and why major American banks are quietly closing their short positions at massive losses. Before we go any further, let me ask you something important. Have you been watching the markets for years? Have you seen cycles come and go? Bull markets, bear markets, crashes, recoveries? Have you heard every prediction imaginable? Because what I'm about to show you is not a prediction. This is pattern recognition. This is documented evidence. This is real-time institutional behavior, and it reveals everything. So do yourself a favor right now. Hit that subscribe button. I know everyone asks for subscriptions, but here's the difference. I don't waste your time with hype. I don't sell dreams. I give you data, evidence, and strategic warnings. The kind of information serious investors actually need. Subscribe and turn on notifications, because what happens next in the silver market will determine who preserves wealth and who loses everything. And before we dive in, drop a comment below and tell me where you're watching from. The United States, Europe, Asia, Latin America. Let me know, because what's coming affects everyone, but how it affects you depends on where you are and how you are positioned. Now let's talk about what BlackRock just did and why it should make you pay very close attention. What BlackRock is doing right now, January 2026. While financial media fills your screen with noise about stock market rallies and economic optimism, something extraordinary is unfolding inside the marble corridors of the world's largest asset manager, BlackRock. This is the firm that manages over $10 trillion in assets, the firm that can move markets with a single allocation decision, the firm with more financial power than most countries. And right now, BlackRock is accumulating silver, not small amounts, not token positions, not speculative trades. We're talking massive institutional scale accumulation of physical silver and silver-backed securities, billions of dollars flowing quietly into silver positions. No press releases, no announcements, no fanfare, just steady, relentless buying day after day after day. But here's where things get truly explosive. At the exact same time, BlackRock is accumulating silver, major American banks, the same institutions that have suppressed silver prices for decades through massive short positions, are closing those shorts, and they're not closing them at a profit. They're closing them at huge losses. Banks that never use stop losses, banks that normally hold positions indefinitely, banks with bottomless liquidity and infinite patience, they are panic closing their silver shorts. Let me be crystal clear about what this means. Banks do not close losing positions unless they absolutely have to. They have algorithms. They have risk models. They have access to Federal Reserve liquidity. They can sit on losing trades for years waiting for reversals. But right now, in January 2026, they're closing silver shorts at a loss. Why? Because they've realized something terrifying. Silver is not coming back down. And even if it pulls back temporarily, it will never return to their entry prices. These banks shorted silver at $22, $24, $26, expecting a collapse back into the teens. They added shorts at $30, $35, $40, convinced the rally would fail. They doubled down at $50, $60, $70. Absolutely certain manipulation would work one more time. And now silver is at $90, pushing toward $100. They're trapped. Their positions are hemorrhaging money. Their risk managers are panicking. Their models are broken. And they know that if they don't close now, the losses become catastrophic. So they're buying frantically. And here's the key mechanic most people don't understand. Closing shorts means buying silver. When banks with billions in short exposure start buying to close, it creates enormous upward pressure. It becomes a self-reinforcing feedback loop. Price rises, losses increase, risk limits are hit, forced buying accelerates. This is how squeezes happen. And now I want to show you the part that should make you absolutely furious. How retail is being used as exit liquidity. While these banks are panic buying silver to close their losing shorts, their retail broker divisions are calling clients. Yes, you, the individual investor who bought silver at $30, $50, or $70. And what are they telling you? They're telling you to take profits. They're telling you silver is overextended. They're warning a correction is coming. They're advising you to sell. Ask yourself this. Why would banks tell retail investors to sell the exact asset the bank itself is desperately buying? Because they want your silver. They want your positions. They want your contracts. They want your physical supply. They want you to sell at $90 so they can buy it to close their shorts. They're using their position of trust as your broker to manufacture fear so they can steal your exit liquidity. This is not conspiracy theory. This is standard institutional playbook. Create fear in retail, use media connections to spread negative narratives, have brokers suggest taking profits, all while the institutional desk buys as fast as possible. They're trying to shake you out before the real move begins because they know what comes next. Why BlackRock's move changes? Everything. BlackRock doesn't gamble. They don't chase memes. They don't follow retail sentiment. They don't speculate. They move based on deep institutional analysis, decades of market data, and models that process more information than any human ever could. And right now, those models are screaming one thing: buy silver. Not as a trade, not as a speculation, but as a strategic allocation, as portfolio insurance, as protection against what's coming next in the monetary system. BlackRock isn't buying silver because they think it might go up. They're buying silver because they've calculated that in the environment we're entering, silver is one of the only assets capable of preserving purchasing power. But BlackRock's buying is only half the story. The other half, the part driving the explosive price action, is the banks closing shorts. How the silver suppression finally broke. For decades, a small group of major banks held massive short positions in silver. These weren't legitimate hedges. They weren't market making. They were naked shorts designed to suppress price. Sell silver you don't have, create artificial supply, drive price down, cover lower, repeat. It worked for years. Why? Because investment demand was low, industrial demand was predictable, and silver was ignored. But that changed in 2024 and 2025. China began accumulating silver aggressively, not as a trade, but as strategic policy. India's demand exploded as its middle class sought inflation protection. Industrial demand surged due to solar, electrification, and energy transition. And Basel banking regulations made naked shorts far more expensive to hold. The banks assumed this was another temporary spike, like 2011. They added shorts, they pushed margin hikes, they launched media campaigns, and it didn't work. Silver kept rising. $50, $60, $70, $80, losses mounted. And when silver hit $90, something broke psychologically. They realized they weren't fighting retail traders anymore. They were fighting sovereign nations. They were fighting industrial users with inelastic demand. They were fighting a physical shortage that paper contracts couldn't fix. So they started closing, quietly, systematically, every single day. And forced buying at this scale changes everything. Because when shorts must buy regardless of price, price discovery explodes. And that's where we are now. This isn't the end of the move. This is the beginning. And the next phase will decide who keeps their wealth and who gives it away. The pressure to close is intensifying. That is what S driving silver from the mid-80s to $90 and beyond right now. Not retail FOMO, not speculative excess. What we are witnessing is institutional short covering combined with aggressive accumulation by BlackRock. The smartest money on the planet is buying, while the most overextended shorts, the same banks that manipulated this market for decades, are being forced to buy just to survive. This is a perfect storm of bullish pressure. And now this is where it becomes personal. This is where it affects you directly. At some point, maybe not today, maybe not this week, but if you hold silver positions, especially profitable ones, your broker will call you. And when they do, they won't sound aggressive or manipulative. They'll sound reasonable, professional, helpful. They'll congratulate you on your gains. They'll tell you silver has had an incredible run. Then they'll say something like, "Don't you think it might be smart to take some profits? Oh, luck in the win. Nobody ever went broke taking profits." It sounds like good advice. It sounds responsible. It sounds like someone looking out for your interests. But here's the question you must ask yourself. If silver is so overextended, if a correction is truly imminent, why isn't your broker shorting it? Why isn't the bank putting its own capital behind that advice? Because they know what's really happening. They know their institutional desk is buying, not selling. They know their bank is accumulating while the retail side is trying to scare you out. They'll pivot to technical language next. They'll talk about momentum indicators. They'll tell you the RSI is overbought. They'll say every technical signal points to a pullback. They'll suggest selling now and buying back lower. It sounds analytical. It sounds intelligent. But technical indicators do not matter when sovereign nations and trillion-dollar institutions are buying in unlimited size. Technical analysis assumes a normal market. This is not a normal market. This is a paradigm shift. Then comes the psychological pressure. They'll warn you not to be greedy. They'll remind you how much you've already made. 50%, 100%, maybe 200%. They'll say smart traders take profits and move on. This is not investment advice. This is emotional manipulation. They're triggering your fear of giving back gains. They're reframing conviction as greed. And they are doing it because silver at $90 is not expensive. It is still dramatically undervalued relative to its monetary role, its industrial necessity, and its supply constraints. So what should you do when that call comes? First, ask one simple question. Is your institutional desk buying or selling silver right now? They will not answer directly. They'll deflect. They'll tell you they can't comment on institutional strategies. That evasion tells you everything. If the bank were selling, they would tell you proudly. Silence only exists when truth is inconvenient. Second, remember why you bought silver in the first place. If you bought it as a short-term trade, hoping to flip it quickly, then yes, taking some profits might make sense. But if you bought silver as protection against currency debasement, as insurance against systemic instability, as a store of value during a monetary transition, then nothing has changed. In fact, the reasons you bought silver are stronger now than they've ever been. Third, understand this clearly. This is not the end of the silver rally. This is the acceleration phase. Silver at $90 is heading to $100, then $150, then $200, and potentially beyond. Not because of hype, not because of speculation, because of mathematics. Because industrial demand exceeds mine supply, because sovereign accumulation is relentless, because bank short covering will continue for months, because the monetary system is breaking down exactly as historical patterns predict. Let me put real numbers behind this so you understand the scale of what's happening. Global silver mine production is approximately 850 million ounces per year. That is the total supply from every mine on Earth. Industrial demand alone, electronics, solar panels, batteries, medical applications, consumes roughly 600 million ounces per year. That leaves just 250 million ounces for investment demand, jewelry, and sovereign purchases. But investment demand has exploded to over 400 million ounces annually. India alone is importing more than 300 million ounces per year. China is buying over 200 million ounces annually. The U.S. military consumes approximately 45 million ounces per year and is actively stockpiling more. Add it all together, and you get total demand exceeding 1.5 billion ounces per year against supply of 850 million. That's a structural deficit of more than 650 million ounces annually. That gap cannot be closed without dramatically higher prices. So where does the missing silver come from? Above ground inventories, silver held in vaults, silver accumulated by investors over decades, silver that was assumed to be available. But those inventories are finite, and they are being drained rapidly. At current rates, available above ground inventories could be exhausted within 3 to 5 years. After that, there is no buffer. Either prices rise high enough to destroy demand, or industrial users simply cannot obtain metal and production halts. This is why BlackRock is buying. This is why banks are closing shorts at massive losses. And this is why your broker is lying to you. Because the people with access to real data, real models, and real institutional intelligence can see what's coming. They see a world where silver at $200 or $300 isn't witty expensive, it is necessary. It's the clearing price where supply finally meets demand. Now let me be very clear about something important. I do not want anyone making reckless financial decisions based on this information. Silver is volatile. It can drop 10 in a single day just as easily as it can rise 10. There will be corrections. There will be engineered sell-offs. There will be moments of panic. Only invest what you can afford to lose. Do not use leverage unless you fully understand the risks. Do not invest money you need for rent, food, or emergencies. Do not mortgage your home. Do not drain retirement accounts. Be responsible. Be measured. Be disciplined. But also understand what responsible positioning actually means. It does not mean staying in cash while currencies devalue. It does not mean trusting bonds while government debt spirals. It does not mean believing a broker telling you to sell the very asset their bank is buying. Responsible positioning means allocating a portion of your wealth, what you can afford to hold long term, into assets that preserve purchasing power during monetary transitions. For most people, that may mean 10-25% of investable assets in physical precious metals, not paper promises, not unallocated claims, not counterparty risk, real metal, coins, bars, secure, allocated storage. Now let me paint a picture of what likely comes next. We're at roughly $90 in January 2026. Bank short covering will continue for weeks, possibly months. That alone could push silver to $120, $130. At the same time, physical shortages are intensifying. Premiums on coins and bars are already $10, $15 over spot. That spread could widen to $20 or $30 as retail demand surges. When silver breaks $100, and it likely will, mainstream media will finally start paying attention. That triggers the FOMO wave. Millions of investors who ignored silver for years will suddenly want exposure. They'll chase at $105, $110, $150. That drives the second leg toward $150. At $150, industrial users panic. Companies that rely on silver for production, technology firms, energy companies, manufacturers, realize they can't wait anymore. They begin forward buying. They lock in supply contracts at any price. That drives the third leg toward $200. And at $200, the narrative changes completely. It's no longer silver is expensive. It becomes the dollar is failing. People stop measuring silver in dollars and start measuring dollars in silver. That is when the monetary transition becomes undeniable. Between here and there, volatility will test you. There will be 15-20% corrections. Media will declare the rally over. Brokers will call again. Weak hands will sell at exactly the wrong moment. Don't be that person. Don't let institutional manipulation take your wealth. Trust what institutions do, not what they say. And finally, understand this pattern has played out before. Every collapsing monetary system follows the same script. Institutions position quietly. The public is reassured. Hard assets are accumulated behind the scenes. It happened in Rome. It happened in Weimar Germany. It happened in every currency collapse in history. Those with information converted paper into real assets before the crisis became obvious. Those who trusted official narratives lost everything. We are in that phase right now. BlackRock is buying billions. Banks are closing shorts at losses. The smart money has already moved. The only question is whether you move with them or become the exit liquidity they are counting on. Silver at $90 is not the top. It is barely the beginning. Now you know it.